Have you ever noticed how certain patterns or maybe mistakes just seem to repeat themselves? Over and over again. It happens in history, definitely in relationships, and yeah, even in something as complex as the stock market. All right, let's dive right in. Today, we're taking a deep dive into John Boyk's incredible book, How Legendary Traders Made Millions.
Yeah, it's a fascinating read. And this book isn't just like a collection of stories. Boyk really meticulously distills the investment strategies, the actual experiences of some of the greatest stock traders across more than a century.
Wow, over a century.
Yeah, from 1897 all the way through 2004. So think about the sheer range of market cycles, the economic shifts, everything covered in that time frame.
Okay, so our goal for you today is to really pull out the most important nuggets of knowledge, the key insights from their real-world battles with the market.
Exactly. We're talking about strategies they used when their own money, their own capital, was truly on the line.
And we want to show you why these patterns seem to repeat, and maybe more importantly, how understanding them can give you a powerful toolkit for navigating, future market cycles.
And what's truly fascinating, really, is how consistent these observations are, spanning decades. You have legendary traders like Jesse Livermore noting this way back in 1923,
Wow.
and then William J. O'Neill echoing it decades later. They both saw that the same mistakes cause losses cycle after cycle.
But there's a flip side, right?
There is, because successful stocks, the big winners, they also follow certain patterns. And the reason, well, it comes down to human nature. At its core, it just doesn't change.
That's a pretty profound thought to kick us off. So if human nature is the constant, let's really dig into that, this core idea of the market's enduring cycles.
Yep.
What exactly is this central premise? That the market keeps repeating itself simply because human nature never changes.
Well, it's kind of the bedrock. The market isn't some random walk, despite what some theories might suggest. It's inherently cyclical, and it's not driven by some mystical force. It's really the collective emotional expectations of millions of participants.
Millions, so individual investors, big institutions.
Yeah, individuals, and crucially, the major money managers who control these huge pools of capital. That collective human emotion, the fear, greed, hope, it creates these somewhat predictable waves, boom and bust.
In a sense. I remember reading that Gerald Loeb, another one of these titans, he actually described the marketplace as a battle.
He did, a battleground.
And he emphasized that the winners, the successful traders, they learned from history, they learned from their own mistakes. Importantly, they cut their losses.
Crucial.
And they constantly stayed in sync with the market's rhythm. That feels like a very active, engaged way to view it, not passive at all.
Absolutely not passive. And if we connect this to the bigger picture, it really highlights how the market often discounts things back to the present. It looks ahead.
Okay, what do you mean by looks ahead?
Well, it frequently turns before major economic events are officially announced. For instance, the market typically declined or maybe flattened out before recessions were officially declared.
Right.
And then it often rose sharply before those recessions officially ended. We saw this pattern time and time again. 1907, 1908, 1914, 1932, 1953.
Wow, that's a long list.
It is 1974, 1982, 1990, and even more recently, like 2002, 2003. So this raises a really important question for you, the listener. If the market consistently looks ahead, what does that mean for how you should approach information, like breaking news events?
That's a really powerful distinction. So it's less about reacting to the headline news and more about interpreting the market's action as the true news, kind of anticipating events based on price and volume.
Exactly. You're reading the tape, reading the market's mind, so to speak, rather than just reacting to what the economists or the news anchors are saying after the fact.
It definitely challenges that common perception, doesn't it? That
Yeah.
market ups and downs are just random noise or, irrational behavior.
It does, and the book provides pretty clear evidence that knowing this history, especially in this repeating environment of the stock market, it really clarifies profitable opportunities. And just as importantly, offers protection from big losses. It's not chaos, it's patterns driven by psychology.
Okay, so understanding the patterns is step one. But that brings us to the next crucial piece, the mindset needed to actually act on that knowledge. What does Boyd's book say about cultivating things like discipline, patience, having solid rules?
Yeah, this is huge.
Because it points out something stark. Personal opinions, even other people's opinions, they often don't mean a thing and usually end up getting most people in trouble.
That's absolutely spot on. The book shows again and again that the real reasons for long-term success are discipline, patience, and almost rigid adherence to solid trading rules.
Even for the legends.
Oh, especially for them. Even the most successful traders we're discussing, they lost money, they lost big sometimes, specifically when they strayed from those fundamental traits, those skills, those rules that have, really stood the test of time.
It sounds like a constant internal battle then, even for the greats.
It absolutely is. It's
Yeah.
easy to know the rules, much harder to follow them under pressure.
That level of discipline.
Yeah.
It sounds incredible. Can you give us an example? Like, how did one of these legendary traders really go the extra mile to maintain their rules?
Okay, Bernard Baruch is a great example. Even in his early 60s, right? With 40 years of market experience already under his belt.
40 years.
Yeah, I know. He actually wrote a memo to himself in 1930, like a personal reminder.
What did it say?
He reminded himself, never try to pinpoint the exact bottom or the exact top. It's just too difficult, maybe impossible. He stressed always cutting losses short, letting profits run.
The classic advice.
The classic, yeah. But he felt the need to write it down. Be quick to act when the market moves. Stay in sync with the current market's actions, not yesterday's. And also, think about adverse possibilities. Understand the history. It's almost like his own personal trading commandments.
Wow. Writing yourself a memo at 60 with 40 years experience, it almost makes you feel like maybe I should have my own little trading rules stuck in the fridge, right?
Uh-huh. Maybe not a bad idea.
And it ties into that famous Jesse Livermore observation, too. The big money is made in the big swings. And it's not the thinking that makes the money, it's the sitting.
Ah, yes. It's the
What's the core practical takeaway there? Especially for listeners who maybe struggle with overthinking their positions, constantly tinkering.
Livermore's idea of sitting is, well, it's profound in its simplicity. It really just means patience. Patience with your winning positions.
Okay.
Once you're in a strong, confirmed trend, the biggest gains often come from simply holding that position, letting the trend play out, not constantly analyzing, second-guessing, trying to time every tiny little dip and rally.
Let the market do the heavy lifting, not your brain.
Exactly. Let the trend be your friend, as they say. Control the urge to constantly do something.
Perseverance seems like a massive trait here, too.
Yeah.
I mean, you mentioned some of these traders took huge hits early in their careers, right? But they came back stronger. Tell us about Gerald Loeb's experience with those early losses.
Absolutely. Loeb's story is powerful. He had a major loss in 1923 that nearly wiped him out completely.
Ouch.
Yeah. Then, not long after, a second significant loss, this time on an oil stock tip somebody gave him.
The dreaded tip.
The dreaded tip. But those really tough, painful lessons taught him crucial things. Pull your money out when the trend turns against you. Don't argue with it. And always, always do your own research. Don't rely on others.
And that helped him later.
Hugely. He directly attributed his ability to avoid losing significant money in the 1929 Great Crash to those early, painful lessons. They forced him to be flexible, to rely on his own judgment and rules.
Okay, this is where it gets really interesting for me. One of the newer legendary traders profiled in the book, Jim Rappel, he attributes his big turnaround to what he calls his golden rule, which is cutting all losses short, period.
Yes, Rappel's rule is very specific.
Yeah. Can you break that down, his specific rule for us?
Yeah, he has this 3%, 5%, 7% rule for selling. So if a stock falls 3% from his buy point, he sells 1/3 of his position.
Okay.
If it drops to 5% below his buy point, he sells another third.
In his last bet.
If it hits 7% down, boom, he sells the remainder. No questions asked. He sticks to this religiously. Even if a stock gaps down overnight below that 7% level, he just sells it at the market open.
Well, that's discipline. No hoping it comes back.
None. Zero hope involved. It's mechanical. And he mentioned he studied O'Neill's book, How to Make Money in Stocks, no less than 30 times.
30 times.
30 times. And Loeb's battle for investment survival repeatedly, it mirrors that same dedication to study, to internalizing the rules that we saw in Livermore and Loeb decades earlier. That commitment to rules and constant learning, that's what seems to underpin the consistent success.
Okay, so they developed the mindset, the rules, the discipline. What was the actual how-to then? How did these traders read the market day to day? What were they focusing on if it wasn't, say, academic theories or economic forecasts?
Right. They focused intensely, almost obsessively, on market action, price and volume.
Yeah.
The detail.
Just the facts on the tape.
Pretty much. They weren't really interested in what some academic paper suggested the market should do based on efficient market hypothesis or whatever. They cared about what it was actually doing right now. The price action, the volume traded, that was their truth.
And in that action, they observed these consistent patterns. especially in successful stocks.
Yeah.
You mentioned Livermore and O'Neill both noted that leading stocks follow certain patterns.
Yes.
These are the stocks that really drive the uptrends, but they also lead the downturns, right?
Right.
Often falling much more than the general market averages.
That's a key observation. These leaders, the stocks everyone wants on the way up, they often get hit the hardest when the tide turns. For instance, General Motors back in the day, it saw a staggering 91% drop from its peak in 1916 down to its lows in 1917.
91%.
Yeah, from $850 peak to $74.50. And Bethlehem Steel, another giant of that era, plunged from $700 to $66.25. These were the market darlings, and when they started breaking down severely, it was a huge warning sign for the overall market.
And it wasn't always the same industries leading, was it?
No, absolutely not. What's also crystal clear from the history is the rotation of leading industries over time. We saw railroads dominate, then steel came along, then autos changed everything.
And radio electronics.
Exactly. Radio, electronics, later technology, the internet boom. This history really highlights how crucial flexibility is for a trader. You have to be willing to change your views, to shift focus as the market landscape evolves. You just can't get married to one industry or sector forever. The leaders change.
Let's talk about those specific market signals they watched. What did they see at market tops? When things felt great, maybe euphoric, but trouble was brewing.
Right. At market tops, these legendary traders looked for telltale signs. Things like the established leading stocks stopping their advance, maybe pulling back and then failing to bounce back strongly.
Losing momentum.
Losing momentum, exactly. And critically, heavy volume down days. They called these distribution days.
Distribution days, meaning
It's a classic sign that large institutional investors, the smart money, supposedly are beginning to quietly sell off their large holdings while the public is still buying.
unloading onto the unsuspecting crowd.
Sort of, yeah. Livermore, for instance, he noticed the market's inability to make further headway and saw leaders topping out way back in 1906. That's what prompted him to establish short positions before the big panic of 1907. He profited massively from it.
Wow. In 1929? Were there signs then too?
Oh, definitely. There was clear topping action in September 1929. Heavy selling was occurring a full month before the infamous October 29th crash. And the leaders of that era, RCA, Westinghouse, U.S. Steel, GE, they were already falling hard, breaking below key support levels.
So the warnings were there for those who knew what to look for.
They were. Fast forward, O'Neill issued warnings in 1966 and again in early 2000, before the dot-com bust. He saw classic topping signs. Things like Boeing forming a head and shoulders pattern.
That's a specific chart pattern.
Yeah, it's a well-known chart formation that often signals a trend reversal from up to down. Motorola showed a similar breakdown pattern around the same time. Leaders were breaking key support levels on heavy volume. Nicholas Darvis, another trader featured, was apparently out of the market months before the sharp break in 1962. O'Neill himself was 100% in cash 6 weeks before that 62 break.
Incredible. Just sitting in cash while everyone else is still playing, that takes discipline.
It really does. Preserving capital is key.
Okay, that's tops. What about market bottoms? What did they look for when things seemed absolutely terrible, sentiment was awful, and everyone else was probably giving up and selling everything?
For bottoms, they look for specific confirmation signals, too. O'Neill, in particular, meticulously studied market bottoms and identified what he called follow-through days.
Follow-through days. Okay, what are those?
A follow-through day is essentially a strong confirmation signal that a new uptrend might be starting. It typically occurs on the 4th to 7th day of a rally attempt off a significant low.
And what does it look like specifically?
You're looking for the market index, say the S&P 500 or NASDAQ, to be up significantly, maybe 1%, 1.5%, or even more on a particular day. And critically, that upward move must happen on much heavier volume than average.
So strong price move plus strong volume confirms buying interest.
Exactly. It shows conviction. O'Neill's research showed that basically no major bull market in the U.S., going back decades, ever started without one of these follow-through days.
Can you give an example?
Sure. He cited October 1974. After a brutal bear market, the S&P 500 jumped 4.6% on heavy volume one day. That was the follow-through. It was followed shortly after by another jump of 2.9% on the heaviest volume seen in over a year. That confirmed the bottom was likely in.
And 1982, the start of that huge bull run.
Similar pattern. August 1982, the S&P 500 had its follow-through 5 sessions after hitting its ultimate low. That signaled the start of a massive multi-year bull market.
And Rebel had an analogy for this, didn't he? Something about basketballs.
Yeah, Jim Rappel uses the analogy of basketballs underwater. When the market finally turns up after being suppressed, he looks for those leading stocks that have been forming basing patterns, periods of consolidation, after a decline to suddenly spring out of those bases with real force on huge volume, like a basketball held underwater finally shooting up to the surface. That explosive move is what he wants to see.
I like that visual. Okay, so they wait for the market turn signal like a follow-through. But when it came to choosing which individual stocks to buy, it wasn't about diversifying across hundreds or thousands of companies, was it?
No, quite the opposite, actually. They focused intensely on the absolute best, often just the top 1% or 2% of all stocks available at that time.
The cream of the crop. What defined best for them?
They looked for companies with truly superior new products or services, something innovative. They needed strong revenue and profit growth, typically 25% year over year or more, and ideally that growth rate was accelerating.
Accelerating growth, okay.
Yeah.
Anything else?
Yes, strong profitability metrics like a high return on equity, ideally in the 25% to 50% range, with a minimum threshold usually around 17%. They wanted companies that were efficient and highly profitable.
Interesting. And was there anything about the age of the companies?
Yeah, that's a fascinating point from O'Neill's research. He found that something like 80% of the biggest new market leaders in any cycle had had their initial public offering, IPO, within the prior 8 years.
80%. So relatively young, innovative companies often lead the charge.
It suggests that, yeah, that dynamism, that innovation often comes from newer public companies disrupting older industries.
Let's look at some of these ideas in action with specific stocks. RCA in the 1920s seems like a classic example of one of these leading stocks, right?
Oh, absolutely textbook. RCA went from around $32 a share in 1926 to an astonishing $574 in 1929.
Wow, what fueled that?
It was fueled by an incredible 1,100% increase in earnings over that period. It was the leader, the dominant force in a brand new, revolutionary leading industry at the time, radio. It ticked all the boxes.
Okay, and jumping forward, O'Neill's purchase of eBay in 2002. That sounds like a direct application of his studies, maybe buying after a bottom and a follow-through day.
It was precisely. He bought eBay coming off the 2002 market bottom. He noted it was very similar pattern-wise to how he had bought Chrysler coming off the 1962 bottom decades earlier.
And both worked out.
Both became huge winners for him. It really demonstrates the power of recognizing these repeating patterns he had identified and studied so carefully.
Then there's Jim Rappel again, with his later wins in 2004. He bought Apple Computer and also Google. What's interesting about the Apple purchase is that the book says he had to overcome his own opinion about the stock.
Right. He apparently wasn't initially a huge fan of Apple's prospects or valuation at the time, but the stock's action, the price and volume was so strong, so compelling, that he followed his rules and bought it anyway, despite his personal bias.
And Google. That was a relatively new IPO then, right?
Yeah.
Not much chart history.
Exactly. With Google, despite that minimal chart history, because it was a pretty new issue, he focused on its incredibly strong fundamentals, the growth, the dominance in search, and the clear signs of heavy institutional interest, big funds buying it.
So those two examples really show his mastery of flexibility, wouldn't you say?
I would. It shows he wasn't rigid in his opinions. He didn't let personal bias about Apple or the lack of a long chart history for Google dictate his decisions. He adapted to what the market and the fundamentals were telling him right then and there, even when it went against his initial gut feeling or usual preferences. That's a hallmark of true discipline, I think.
Absolutely. Which brings us neatly to maybe the most challenging area of all, the psychology of trading. Because it seems like all these legendary traders stressed, again and again, that emotions are often your own worst enemy.
Oh, without a doubt.
It's one thing to have the rules, the knowledge,
Yeah.
but it's entirely another thing to actually follow them when the market is volatile, when fear or greed is trying to take over.
That's the recurring and incredibly difficult theme, isn't it? Bernard Baruch, we mentioned him writing memos. He really emphasized critical thinking, constantly questioning your own assumptions, specifically because he recognized how easily emotions can lead you completely astray.
And Loeb learned this the hard way, too.
He did. That loss back in 1926, which we talked about, it taught him, in his words, that flexibility in the market is the most important trait one could possess. He also learned a tough lesson watching former market leaders after the 1929 crash.
Like which ones?
Stocks like New York Central Railroad or Consolidated Edison Utility, giants of their time. He noted many of them never came back to their peak prices, even when the broader market eventually recovered years later.
Wow. So holding on to old leaders, hoping they'll return, can be a trap.
A major trap. It just reinforces the need for that flexible, unemotional selling when the trend clearly breaks down. Don't get attached.
And then there's the danger of mob psychology, right? Getting swept up in the crowd, listening to hot tips. That seems like a classic pitfall.
It truly is a tale as old as markets themselves. A Baruch and also Joseph Kennedy, for example, they famously became very suspicious, very cautious near the 1929 peak, precisely because even shoeshine boys were suddenly offering them stock tips.
That's the classic anecdote, isn't it? When everyone's an expert.
It's a classic sign that speculation has gone rampant, the market is overheated, and the end might be near. And even Loeb, despite his experience, admitted losing his sense of proportion at one point, buying a stock he'd vowed never to own simply because he got caught up listening to tipsters.
So even the best can stumble and fall prey to it.
Absolutely. It shows they're human. Lowe even admitted later, it was easy to write "cut your losses short" in his books, but it was much harder to do it in the heat of the moment, referencing a time in 1946 when he hesitated. It just shows that even for them, it was a constant conscious battle against their own impulses, against that very human desire to be right or to follow the crowd.
So one powerful strategy, almost a psychological defense mechanism that many of these traders used, was simply staying out. Getting out of the market when conditions look dangerous.
Exactly. Preserving capital was paramount. These great traders often drastically cut back their trading activity or sometimes stayed completely in cash during dangerous, choppy, or clearly declining market environments.
They just sat on the sidelines.
Yep.
Baruch did this for periods in the 1930s. O'Neill was largely in cash during difficult markets like 1962, 2000, 2001. Rappel did the same in 2001, 2002. They recognized when the odds simply weren't stacked in their favor, and they had the discipline to just preserve their capital, wait patiently for clearer skies, for better opportunities to emerge.
That seems wise. But there was one incredible exception mentioned in the book, wasn't there? Gerald Loeb. The book says he achieved the remarkable feat of actually making money every single year from 1929 through 1932.
Yes, right through the absolute depths of the Great Depression bear market.
On the long side, buying stocks. How on earth did he manage that when the market was crashing all around him?
That was highly unusual and really demonstrates truly exceptional skill and adaptability. He apparently achieved it by making very quick, nimble in-and-out trades.
Scalping, almost.
Sort of like that, maybe. Short-term trading. Keeping any losses very well contained, as the book says, tiny stops. And crucially, reacting precisely to the immediate market actions, the short-term bounces, rather than trying to fight the major overwhelming downtrend. So he wasn't trying to predict the ultimate bottom, just playing the short-term ripples.
Exactly. He was just reacting to the temporary opportunities that presented themselves, no matter how brief they might be. It really speaks volumes about adapting your strategy completely to the prevailing market environment, however hostile it might be.
Okay, so after all that, what does this all mean for you, our listener, trying to navigate today's markets?
Yeah.
We've journeyed through, well, more than a century of market history here.
We have.
Seeing how human emotions, fear, greed, hope, consistently seem to drive these repeatable patterns. The wisdom from these legendary traders, it really isn't about having a crystal ball to predict the future perfectly, is it?
No, not at all. It's much more about understanding the timeless signals the market itself offers if you know how to look and listen.
So just to recap the core lessons then.
Yeah, I think they're pretty clear. First, recognize the repeating nature of market cycles, driven by that unchanging human psychology. Second, cultivate extreme discipline and patience. Third, always cut losses short that seems non-negotiable. Fourth, learn to identify and follow the leading stocks, the true market generals. And fifth, adapt to the market's current trend. Don't fight the tape. Don't get swayed by your own emotions or the crowd's opinion.
These principles, really forged in the fire of decades of real-world trading, seem like a pretty powerful foundation.
I think they are. Very powerful.
Okay, so let's end with a final provocative thought for you to consider. Given that the market is truly this battle, as Loeb put it, where human nature consistently creates these repeating patterns, and given that even the greatest traders we've discussed had to constantly battle their own emotions and learn from history to achieve their success, consider this. What new frontier, what major shift, maybe technological, maybe societal, maybe something else entirely, do you think might emerge in the coming decades that could genuinely challenge these time-tested principles? Or will they perhaps forever remain the bedrock of successful trading no matter what changes? Something to think about.